With India's GDP having put foot on the accelerator, there are a few sectors that will provide the maximum fuel to growth. Is manufacturing one of them? If yes, how will it impact the growth wheel of India? To answer these, let's welcome the panelists of our next session who will discuss on how will manufacturing businessing during a turnaround in the Indian economy. The panelists are Mr. Vikas Khemani. He is the CEO and CIO at Carnelian Asset Advisors. He's a chartered accountant and CFA charter holder. He has 22 years of capital markets experience, most recently as the CEO of Edelweiss Securities Limited, where he spent 17 years incubating and building several businesses to leadership, including institutional equities business and equity research. Vikas served as a member of the CII National Council on Corporate Governance and FICCI Capital Markets Committee. He has been awarded with Young Professional Achievers Award for the service sector by the Institute of Chartered Accountants of India in 2014. Our next panelist is Mr. Anup Maheshwari. He is the co-founder and Chief Investment Officer at IIFL Asset Management. Anup is responsible for the investment and strategy for IIFL AMC's business, including mutual funds and alternative investment funds. An alumnus of Indian Institute of Management, he has over 25 years of work experience in the financial services sector. Prior to IIFL, he has been associated with the DSP Investment Managers Private Limited for over 21 years as an executive vice president and chief investment officer. He was also associated with HSBC Asset Management and Merrill Lynch India Equities Fund Limited. And our third panelist is Mr. Manish Sonthalia. He serves as the Chief Investment Officer and Executive Director of the Motilal Oswal Asset Management Company Limited. He has over 30 years of experience across equity fund management and research covering Indian markets, with over 18 years with Motilal Oswal. He holds a bachelor degree in commerce from St. Xavier's College, Kolkata, and is a member of the Institute of Cost and Works Account of India, the Institute of Chartered Accounts of India, and the Institute of Company Secretaries of India. Let me now introduce you to the moderator for this session, Ms. N. Mahalakshmi, a financial journalist of 25 plus years in an authoritative media voice. She is part of the senior leadership team at Network 18 and currently leads markets and economy coverage at Money Control. She was earlier the editor of Outlook Business and Outlook Profit magazines, and before that, the editor of Markets and Investing at Business Standard newspaper. Over to you, Ms. Mahalakshmi.
Thank you, Akriti. This is particularly an exciting topic, the discussion for today, manufacturing business how will manufacturing business turn around the Indian economy? It's really a hot topic. And three amazing people, Vikas, Anup, and Manish, thank you so much for agreeing to do this. And thanks so much to PMS AIF and Kamal for organizing this beautiful event. First of all, let me put my 2 cents into this and set the context for this discussion. Obviously, over the last 3 decades, there has been a feeling that India has lost out on manufacturing, and that is for us to see. There has been a systematic decline in manufacturing. There were various reasons, not just that there was absence of policy push, which conspired to diminish the dominance of manufacturing for India. Now, there are 3 parts to the GDP: manufacturing, agriculture, services growing, manufacturing, we have been debilitated. Agriculture remains a fairly vulnerable piece and probably more vulnerable because of climate change today. But this has an important contribution to make, and it is not just from contribution to GDP perspective, but a lot of second and third order effects. The fact that it can increase jobs, the fact that it can increase individuals of incomes of individuals and spur consumption. It can propel growth. It can reduce imports. and therefore minimize the pressure on on foreign exchange. All of these important aspects to manufacturing. And now the administration has clearly recognize that this is a part of the economy that we cannot ignore, and the policy directive has been to strengthen manufacturing. And of course, we have tailwinds now. The macro geopolitical situation is also in our favor. There is this China +1, which has been playing out for more than 5 years now, Europe +1, and our own policies in terms of Atmanirbhar and all of that. So one, from the area that manufacturing can alter the course of Indian economy, and second, how does this really get represented in the stock market? What are the wealth creation opportunities that we can really benefit from? To discuss this, let me lead with Vikas. Vikas, tell us, how do you think the big picture really looks? If you just stretch out 5 years from now, let's start with 3 to 5 years from now, how do you see this manufacturing push really altering the complexion of the Indian economy? And of course, we'll take it from there.
So first of all, thank you very much for having me, invited to this session, and especially with the company of the panelists who are accomplished in their field. Coming to your question, Mahalakshmi, I think manufacturing has been one of the biggest pain point of Indian economy for many years. I think last probably a little bit push was given in manufacturing was early 90s or post liberalization, in the mid 90s we saw some. But other than that, I think manufacturing has been a very big pain point. We never invested anything in we have a large population, so most of the consumption now kind of depends on the imports, especially from China. And of course, the globalization kind of added to it because Chinese produced goods cheap, and that made all the more things worse for Indian economy and Indian manufacturers. I think, and that reduced our manufacturing share of GDP to less than 15%. And that has kind of remained there static for last 20 years, almost there. And there's an acute need to which government has felt, this government has been saying for some time, but I think in last 2 years, concrete measures have been taken to address this. And government is of course targeting to take this share to 25%, which is not easy, which is very sort of aggressive task and tall ask. Of course, nothing is impossible, but even if I were to take, let's say for time being, a mid number of 20%, right, which is fairly achievable, but that itself means that our Indian manufacturing GDP, which is thereabouts of $450 billion to $500 billion, will reach to almost close to $1 trillion, which means we'll be doubling our manufacturing GDP. And that has severe implications, specifically on 3 counts. Number one, I think when you add this kind of manufacturing GDP, you will add serious amount of jobs. So to give you a sort of context on that, in manufacturing, if you add $500 billion of GDP, the wage ratio is roughly about 10%. So you will add $50 billion of salary spent into the economy, both blue collar and white collar, and that will have a huge multiplier impact. Manrega, which was a huge demand booster when it was introduced in 2009, the annual allocation to that has been around $10 billion. So you are basically talking about this manufacturing shift, if it happens, 5 times of Manrega coming only from this one sort of figure, which is I'm talking about 20% mark. So that is huge multiplier impact. Second, whenever you do manufacturing, you need huge amount of capex. So if you add another $500 billion of GDP, you will need around $150 to $200 billion of capital investment. We have been wanting to have that kicking off for a long time, and I think I'm glad that it has begun, and it will only kind of get better from here. And then lastly, I think the point which you touched upon, that as we import from outside, it obviously puts pressure on our rupee, on our currency reserves, and we import more and we make it up with the capital account sort of flows. But if we reduce our import, our dependence on capital account goes down. And I feel that if we address our manufacturing right, along with few of the things which are happening on the IT sector growth and all, this has the potential to kind of wipe out our current account deficit in the next 5-7 years time. So it basically can lead to our structural repair of the country. So at one level, you are addressing job issue, investment cycle, and current deficit. And all these things can have a very, very far-reaching impact. Can you imagine if our rupee stops depreciating, what kind of implication it can have on the whole economic profile of the country? So I think this is just, of course, it will take time. It will happen. It is not going to happen overnight. But I think this initiative or this big trend has a huge implication for the economy in general, and of course, it will invariably lead to wealth creation cycle in the market.
Fair enough. Anup, from your lens, do you want to add something to this?
Sure, Mahalakshmi, and I'll just echo Vikas's point. It's great to be on the panel with Vikas, Manish, and yourself, and thank PMS AIF for that. To add to this, I guess what we've seen is we've been largely a services-driven economy so far, and when you look at India's share in global GDP as well, or in terms of global trade, services has been a more dominant proportion. We've been 4% market share in world services, but we've been under 2% in manufacturing or goods. And that clearly is largely because of the lack of investment into manufacturing capacity in India's competitiveness on a relative basis historically. But a lot of that is changing. And we think this proportion of manufactured exports, for instance, or India's share will probably also head towards the way our services share has moved. And that's very important for India to be a more significant part of the global economy, to move towards 4% than the current aggregate of about 2.2% today. The other point I'll just add is just to reiterate Vikas's point on the current account deficit. That's been India's biggest bugbear for a long period of time. When you run a persistent current account deficit, you consistently have challenges around your currency and interest rates. Manufacturing clearly is one area that can help address part of that. Services has already done a great job. All our oil imports are effectively neutralized by our service exports. But you do need manufacturing to allow the current account deficit to come down, and that makes growth, interest rates, currency a lot more structural and secular. So very, very important part of the whole India journey, and clearly the time has come from our point of view for manufacturing to start
in the market. Policy initiatives, deleverage balance sheets, opportunities getting created due to deglobalization, China plus one, China plus two, now Europe plus one. I mean, these would manifest itself in terms of a lot of opportunities in India. It depends on entrepreneurs as to how they're going to actually utilize these opportunities that are coming through in the form. And obviously, government is also pushing through PLI. 1.97 lakh crores. They tried with 3 sectors, primarily automobiles, autocoms, electronic manufacturing, solar panels, and all of that. And I'm sure that this is going to go a long way if we have to achieve this $5 trillion mark and eventually to 7.5, as Anand alluded to, 7.5 by 2031. Obviously, the share of manufacturing has to go a long way. In terms of stock markets, how I look at this is basically, if you got to win in the manufacturing space, it comes to right to win. And obviously, you got to be a leader in the area of your, business. When it comes to the manufacturing prowess, economies of scale would drive your efficiencies, or you create better markets or better categories for yourself. You expand the market for yourself in terms of the product. So, that would be my 2 cents on this whole topic right now.
Thanks, Manish. So we'll discuss more on this right to win from a stock market perspective in a bit, but I have a couple of questions. It's fantastic to talk about this resurgence in manufacturing, and we all want Indian economy to go to 5 trillion and 10 trillion. We want manufacturing to grow. But here are my fundamental questions, which I think I also put to all the policymakers I go to, is that it's not that the first time that government is, going for manufacturing incentives. I mean, we've seen this play in pockets multiple times in the past. But unless we have a path, for example, today, PLI is an incentive scheme with 5 to 6% incentive to bridge the cost of doing business in India, in a sense that it's essentially to bridge the inefficiency that the system imposes on businesses so that they become competitive. unless we bridge this 5 to 6% gap over the next 5 years, which is also the targeted period for this incentive, do you think we will be able to cross the hump after 5 years? That's question number one. And I ask this because of two reasons. One is several of these businesses that are coming into India and creating jobs, the Foxcons of the world, these are assembly units where the units can just move overnight to other destinations, and those are becoming the key job creators. That's number one. Second thing is my conversations with a whole bunch of specialty chemical and chemical outsourcing companies which have presence in India as well as in other markets say that there is this strong China plus one push that is acting as a tailwind, and all companies are today willing to pay a 5-10%, 5 to 7, 8, 10% more for Indian manufacturing, for outsourcing from India, but with an understanding that the companies will be able to bridge that gap in 2-3 years, because beyond that, economics will have to take precedence. So, Vikas, do you today have the conviction and confidence that we will be able to overcome these humps?
Yeah, I think very good question, Malakshmi. I think this is a question we get asked all the time, because given whatever has happened, there's a lot of skepticism around this. And so this is a very common question, what's different this time? And I will say there are 4 things which are kind of very different this time. Number one, I think government is making a really all-out concentrated effort in terms of making sure this happens, because government is acutely aware that our vulnerability on China is very, very high. And we know what kind of situation they are. They don't need to have a conflict on the border. They can switch off supply of APIs and your entire healthcare system can come down, right? So, I mean, a lot of vulnerabilities are there. So government is very smartly, PLI is only one of the most popularized talk, but I will give you one nuance that PLI everybody knows. But one thing which I think is not talked about and maybe cannot be talked about is non-tariff barriers. Government is smartly adding non-tariff barriers, whereby, which can't be, which gives protection to the domestic industry. Like recently, you must have heard that toy import from China came down by 60%. Government made only one simple change, that all toy companies have to have BIS mark, and whom to give BIS mark, what phase to give it is completely on their hand, but that way only one single stop. So Indian, government has never used non-tariff barriers historically. First time, I mean, China has 4,000 non-tariff barriers, Japan has 2,000, India has 400. So now we are using first time, and these are the kind of measures which government is taking. So, and I can go on the subject. Also, government is very, very committed to make sure that the local industry thrives, gets opportunity, and protects them from unfair competition which is coming from China. So that's the one part, and that allows Indian ecosystem to get built. And I'm sure over a period of time, as economics of scale build, Indians are no less in anybody in any terms to compete on merits. And I think that is very, very clear. So next 4 or 5 years, we need support, and that government is providing. Number two, I think there's again a very big change happening is in terms of our cost competitiveness has automatically improved. China's minimum wages are about $800. India is about still 200. So China has anyway left that journey for long. They need to prime the economy through consumption, and hence that cost competitiveness has even, in India's favor is building. Our power cost is cheaper than China's power cost today. Our logistics cost is inefficient, but that is being addressed. So I feel that naturally India is being cost competitiveness on many sectors. Of course, some sectors we don't have ecosystem to cater to the demand, which India is building, which government is building through various support systems. Once that gets built, I don't think India is going to be less competitive unless on any count. And number three, China plus one, which is a demand pull, right? So today, I don't think any company can say that I'm importing 100% or I'll continue to import, even if it is cheapest from China. And that ship has again sailed. I think every company is looking to outsource, diversify their supply chain, and which is, I think, in works and happening. So in my opinion, that's a 10-year trend, not even a 2-year trend. So right now, even if we get, I mean, we don't have ecosystem to cater to that entire thing. So short-term transitionally, it might look impossible, but I think in 10 years, you will see this number being a very, very big, serious number for India. And lastly, I think great part about India is that we have our own big domestic demand. So if any MNC wants to set up in India, any plant, they can set up for both export and domestic global scale capacity. So like Apple has set up, Samsung has set up second largest plant. So because, our own demand and export capability, global scale capacities can be set up, and that is attracting many, many MNCs here. So I think combination of these 3-4 factors, I think this time around, it's very, very different. Partly it is policy supportive, but partly it's also demand driven. And when both factors are at work, it is very highly unlikely that this will be at risk. Anything is possible in future. Nobody has seen future, but I think this is a very, very credible move which is there. And I think if I take 8-10 years, I think we'll be looking at a very, very different complexion. And I'll only touch upon one small point which you mentioned, which is a very critical point, that you said that what these are assembling here and it can be shifted. It is not the same case. Think about it. When Maruti came to India, it was importing 99% of the parts from Japan. And over the next 10 years, all components started getting built, ecosystem got built, and they made 99% parts here. And that entire auto component system which we built in India is actually the name of Maruti and Honda at that point in time. They initially were assembling, but then as ecosystem got built, today our capability, competency in auto components is, I think, world known. We can compete with the best in the world. So today when they are coming as assembly, don't undermine saying that these are only assembly. In fullness of time, we will see ecosystem getting built for the components. Indian entrepreneurs will come, businesses will come, attend to, and this will create a huge, large scale employment and opportunity for businesses in general.
Fair enough. So I'll just respond to this last bit that you talked about, that, right now there seems to be a lot of resistance exactly for the same reason that you pointed out, that, while we are getting the assembly units out here, the ecosystem is not getting dislodged from Korea and Taiwan. Most of the ancillary industries ecosystem is very well established. So that ecosystem already, while the China part is looking a lot more clear, what supports that piece in China, which is South Korea and Taiwan, that ecosystem doesn't seem to be getting shaken as yet. And I think that there has to be some trigger for that to come and settle in India for these to become sticky. But we can have more conversation and debate on that. But Anup, do you accept these 3-4 points that Vikas talked about? Non-tariff barriers, of course, is a big part. But let's go in reverse. Demand. Demand is something. In the last 30 years, we have seen that most companies that have come into India and set up shop have only been dismayed with what kind of demand ultimately, what has panned out compared to their assumptions. Does this time give you the confidence that we will surprise on the upside with respect to demand, or aggregate demand is indeed sustainable and as big as we assume it to be?
Sure. Let me try and give you some numbers here, Lakshmi. And first of all, I agree with most of the points Vikas made. I think when you come to demand, when we try to actually assess this across India, and we actually categorized India into 3 cohorts based on incomes: India 1, 2, and 3. Because there's a lot of differential in income. So while our overall per capita GDP is about 2050, but we all know that's not a number to go by. There's a lot of dispersion within that. So India, one of the top 12% households. There are about 36 million homes in India 1, who account for probably 70 to 75% of aggregate demand. And that's really been that small part of India that has been growing and providing a market for existing companies. But what we find really interesting is India 2, as we call it, which is the next 24% homes, which is about 59 million households, who have a per capita income ranging between about $1,200 to $3,500. So India 1 is $3,500 and above. India 2 is $1,200 to $3,500. And that is the part of India that's actually, in terms of percentage growth rates, rising the fastest. So just mathematically, if India 2, 59 million homes continue to grow at the current pace, by the end of this decade, India 2 will start showing consumption patterns of India 1, because your discretionary income keeps rising. Now, there are very few places in the world where you will add that many consumers over the course of a decade. So 59 million homes, let's say in India 2, to convert it to consumers, we normally just multiply it by 2. So about 120 million consumers are coming into the system in India with rising consumption capability over the course of this decade, in addition to the existing base of about 75 million consumers in India 1. And that is a very large population that I think is a very big addressable market for a lot of companies. So I think that's really the key. And even if you just look at broader working population and demographic profiles. Unlike China, which has now peaked, India's working age population will still rise for at least another decade. India is going to be contributing 1/4 of the entire working age or the workforce globally. And therefore, that implies that there has to be a local domestic demand market. So I think the fact that there's a market, I think, is indisputable. I think what we need to do, like you mentioned earlier, is create supply chains, etc., which will come. I think that's an outcome as FDI starts flowing through.
Sure. Manish, again, this is a point I raised in one of the panels yesterday on demand. You talked about the next India, and there has been so much optimism about Bharat in the last few years, especially as we've seen so many venture funded companies come up to tap this market. Only if you saw day before yesterday's, Zomato results, Zomato said their path to profitability is by, the way they are doing it, although they're not saying it, is by cutting down on growth. And they've pulled out from 255 smaller cities. So already you're seeing across companies, a lot of companies are today pulling back on their growth ambitions from smaller cities or the next line where they don't see returns justifying the investment spends. So that's why my question on demand, but Manish, your inputs.
Yeah, so, it is a given that, per capita income in the country is actually going to grow. And because we have the demographic benefit, the middle class is going to bulge in the center, as opposed to the shape of the pyramid, which is very flat. Maybe 10 years ago, less flat now, and maybe it'll become a diamond-shaped few years down the line. But, it's a given that rural economy and the government impetus on uplifting, the lower strata of the society is, to have an inclusive growth is all going to come, but it is going to come very slowly. It's not going to happen, magnificently fast. And when we talk about companies, straddling the entire India piece as a whole, they have to walk a fine balance between profitability and growth. You alluded to Zomato. Numbers are just staggering when we compare ourselves with China. There they deliver some 1,500 crore orders every year. Here we are struggling with, let's say, Zomato and a Swiggy put together. 16 crore or 17 crore orders per quarter translates to roughly around 70 crore orders into 140 crore orders. So, it's and if you see how the trajectory on growth has played out when we compare ourselves to China, it's exactly the same, right? So, the runaway for growth, let's say in the case of food delivery, from 200 crore orders going up to, let's say, 1,200 crore orders, that is a path that is to be given. But the whole thing is spending power in rural India is not as big as that of urban India. So, you get your profits in food delivery, let's say in urban parts of the country. When you're listed in the marketplace, when you talked about TAM, investors punished the company, right? You didn't show the path to profitability. Now they're course correcting that. They are showing them the path to profitability. And once they have a handle on the margin number, the growth will also come through. It's a big picture that is likely to play out that way. So I think this inclusive growth will all depend on government's help, allocations, and gradual upliftment of people out of the lower income, so to speak, and come into the middle class, which is obviously going to grow. A lot of rural India is going to migrate to cities. That's also the big picture theme for the next 5-10 years. Consumption is here to stay. So I would look at it that way.
Fair enough. Vikas, so from a stock market perspective, how do you see this opportunity really play out? One is, of course, all these trade plays that we have seen, whether it is Dixon or Aarti Industries or a whole bunch of companies. But there, the market has already recognized those opportunities for for a good many years now. Are there any other pockets? I mean, do you look at it any differently in terms of how, if you take a slightly longer term frame, let's say 3 to 5 years, do you see these playing out any differently, any new opportunities? For example, if we were to assume jobs are going to be in demand Would you look at staffing companies? Is there any different way of playing these streams apart from what we already see talked about?
First of all, I think Mahalakshmi, it's a very large decadal opportunity, and I think, in my opinion, it'll be very big disservice to say that it has played out, because I think, in any part, first 2 years, of course, there's a euphoria, then this consolidation happens, and then I think again the next leg of run happens. It is part of any sort of run. To give you some sense, I think if you look at 2002 to 2008 run, which was largely capex and investment cycle driven, in that period, companies like Bharat Force went on to become 15x. Thermex became almost 17x. L&T became almost 15x. Now, I mean, if you kind of early part write it off, and I remember that time because we had started, and some people said, "Our stock has gone up 100%. Why should we play now?" And you miss out on the low. So I think I would say probably first of all, one should not be worried about, because it's a long decadal trend. Of course, you can't go and back and buy in 2020. If I had a choice, I would definitely go and buy back, right? So it is right now, according to me, it's early stage, not really very late stage. Number one. Number two, I think so first you play through the sectors which are beneficiary, where whether it is chemicals, specialty chemicals, APIs, consumer electronics, defense, capital goods, toy manufacturing, footwear manufacturing, engineering services, building materials. I mean, it is a very, very, very wide, because we practically import a lot of things. I mean, from China and elsewhere. So first is import substitution, and then export tapping opportunity. Once you have capability, you do see that. So I think the opportunities from both fold, and hence, and in manufacturing, the opportunities are always in step function, because you got to do capex before you get the growth. So you will always see stocks doing well in step function. So it's a huge sort of first order play, and then of course second order play like staffing companies and many more. One can there will be lots of derivatives, and I'll tell you that we every day encounter something new, that this sector is also beneficiary from this. So because when a massive trend comes about, it plays over a period of time, and then you tend to sort of see a very broad based opportunity profile, and still you are seeing many companies coming about, which are at early stage, which can become 5x, 10x in fullness of time. So I would say that, look at from that point of view. And also, I think, it will be wrong to assume that there won't be any hiccups. There won't be, it's only one way green path. There won't be any challenges. There will be challenges. There will be, periods of correction, periods of volatility. No sector has that. I mean, when we had IT cycle, which has created massive wealth in India, we've seen many stocks corrected 40% in that cycle, and then still went on to become 100x and 200x, right? So I, in that sense, see manufacturing pretty in the same way, where probably IT was in mid 90s, or China was there in probably early 2000s, from a manufacturing standpoint of view. So currently, whatever sectors which I just outlined are there, and many more are emerging. Like today, if you have to play toy manufacturing, which is a very big opportunity, there are no playable opportunity in India. But I can tell you 5 years down the line, there will be many companies which will be in the stock markets listed, which will be kind of catering to that demand both domestically as from export point of view. Footwear manufacturing. Today, you can't play many, I mean, there are hardly any play from a footwear manufacturing point of view, not retailing. And, they will come about and they will become large there. Like these niche sectors, niche opportunities will come about. And idea is to keep an eye on it and be believer in it. See, problem is that most of the people are non-believer. If you're a believer in it, if you understand the underpinning of why it will work this time around, you will approach the opportunity from a very different point of view. But if you're skeptic, that time you will always see the temporary opportunity, and then you will probably not. So idea of my at least what I'm trying to communicate is that if you are a believer in it, you will see with the right perspective, and then there are companies with huge capability, huge balance sheets, capability, technical capability, demand, customer credibility, and those are the companies, if you tap, I'm sure one will come out very well.
Sure. Because all points totally well taken. You are saying manufacturing is in the mid 90s of the IT cycle. So are you saying manufacturing as an opportunity is in the mid 90s of the IT cycle, or manufacturing plays from a stock market perspective is in the mid 90s of the IT cycle?
I think both are same in my opinion, because ultimately, over a longer short term, there can be mismatch, but over a 10-year period or 5-year period, both has to go hand in. As the pool grows, the market cap also will get created. It might be possible that, we might have some pockets where the overvaluation is there, and So those tactical sort of adjustment one has to do while investing. But if I were to look at aggregate point of view, I have no doubt that our manufacturing profit pool will grow significantly from here over next 10 years, and thereby contributing to GDP. Just think about it. If we add, if I take 20% target, $500 billion. If I take 25% target, you will add almost $1 trillion of GDP from there. And even if you take market cap to sales ratio 1, you will add anywhere between $500 billion to $1 trillion kind of market cap because of only this. I mean, that's the kind of size of opportunity, and it could be more also depending on the market cycle. So it's a huge wealth creation cycle ahead of us, and that's where I was trying to say that probably it's mid 90s where IT was there, where we are seeing in manufacturing.
Sure, this is, I need Anup and Manish also to come in on this, because my understanding is, the business opportunity may be for a longer run, but it is in the nature of stock markets to front end growth significantly. And that is why you have these bubbles and busts and all of that. You saw 2000, even a company like Infosys struggled another 7-8 years to come back to reclaim its peak in 2000 at its peak. I mean, there are so many other instances of that. Many companies from 2008 crash when XSS got built, another 7-8 years to come back, reclaim those peaks. So the business cycle can be very different from the stock market cycle. So Anup, where do you see the manufacturing stock market cycle from an opportunity perspective?
Yeah, so you're right, Mahalakshmi. I mean, markets can be mispriced in the short run on certain opportunities. We saw that with a lot of the consumer tech names just a couple of years ago.
Yeah.
So there are opportunity sizes that we can all see. And then, of course, there will be points where the market misprices that. But net, as you stretch out those time frames, and you move to effectively a 10-year cycle for this to play out, let's say between now and the end of the decade and maybe a year or two after that, there will still be net value creation, even from today's level. So even if something is overpriced, we've seen this cycle again and again. Things correct, a lot of peripheral players fall out, strong players get stronger. You start establishing who the big beneficiaries are, who the larger companies are, and who are capable of scaling and who are not. And eventually there's a lot of market cap that tends to come through. So if you look at it over a decade period, I think there's a lot of market cap that has to be built up by virtue of manufacturing increasing as a proportion of GDP. That is not captured today, at least from a stock market point of view. If you look at the components of the index, today 50% of the index is still financials and IT, which are more service-driven economies. So manufacturing is still a much smaller portion of the index as compared to what it could be if such a cycle were to play out.
Sure. And you see this expansion in market cap coming from new listings or existing listings growing bigger?
I think it'll be a mix of both. You are bound to have companies coming to the market for capital because this is going to be a capital intensive process, obviously. So you will have new companies that will come. Maybe they're private today, will get listed at some point. There may be some companies where you may not have access to if there's foreign direct investment coming in and routing investments in the ground into the form of exports. Maybe we may not even have access to that in the markets. But suffice it to say, I think there'll be enough money-making opportunities. When so much of value gets created, there are ancillary benefits, there are other as I said, the whole component chain, there are many companies that within that will end up benefiting. So net, there will be a value creation for the country as a whole, and there's some part of it will obviously get captured in the market.
Fair enough. Manish, where do you see manufacturing opportunity from, in terms of cycle, and what are the various ways through which you are playing this opportunity?
So, while the size of the opportunity is all pervasive and well understood, I think at the end of the day, when it comes to making money out of stocks, it will have to be bottom up, right? So, I would believe that it's the right to win that will get you from where you are to somewhere else, higher in the hierarchy. As I said, that either you, in the manufacturing space, either you create economies of scale, that you become a leader in the business where you are present. So large scale manufacturing brings down the cost altogether. or you expand the market for yourself. Right? We are talking about a system today which is working towards deglobalization, self-sufficiency, and at the same time, there's a whole push towards digitization, or let's say artificial intelligence, whole digital ecosystem. So now what the government is giving us the incentives in terms of, let's say, China plus one. So obviously areas like specialty chemicals, like we have proved our prowess in the area of pharmaceuticals, domestic formulation, export formulation. Can we do the same with specialty chemicals? 5 years out, this whole journey started during the COVID. We're already 2 years into it. Maybe the next 3 years, India will create a niche for itself. It's already in the process towards export of specialty chemicals out of India to the global world. And of course, all of this catering to the domestic demand, which itself is growing. Or it could be in the case of, let's say, I just thinking right now, was that, Europe is going through a massive energy crisis. You have the cost of energy going up massively. And then you have the whole ecosystem opportunity of digitization, all of that. How do you fulfill the need for power to actually go through this whole digitization? You won't have power. Can this actually create an opportunity to export power-related products out from India to Europe? Like India created a name for itself in the IT space. Today we are at market share of roughly 4-5% in the global context. Or in the case of, let's say, pharmaceuticals, or let's say an automobile component export, exporting close to $19-20 billion worth of auto comps out of India. So can this happen for power-related goods, right? Can this from 0% market share reach that 4-5% market share? If this is doable, then obviously P multiples won't matter, right? Every P multiple would look very expensive. So keeping in perspective the bottom-up approach in terms of how the growth is shaping up for these individual companies, right? And how the profits are coming through, that will determine and what the valuations are. So valuations, I think, would not be the right metrics to look at when we talk about manufacturing prowess coming to India, because it will all seem very, very expensive. But if the juggernaut has started rolling when it comes to fulfilling domestic demand as well as export opportunities out of India, you could have very exciting opportunity. Government talks about Atmanirbhar. So if defense, which has roughly 2 lakh crores of budget every year, and most of this come in this 300 negative list item, I mean, no P multiple seems to be very expensive if you talk from a less 5 to 10 years perspective, right? We're already seeing all of that play out in the market. As they say, markets are erroneous about pricing how the profit growth is going to play out 5 to 10 years down the line, but they are very correct about the valuation multiples 1 to 2 years down. So the size of the pie just keeps on shifting to the right, as we progress in time. So I think this is the path to understanding how much money is going to be made by these individual companies, what is the right to win, and then the balancing figure would be the valuation, and then that is how you would likely make money.
Sure. Because your last word, because we've completely run out of time, your last word on what is it that we need to be watchful of, if at all?
Looks like that. Of course, there will be risk along the way. There will be currency volatility will be there. There will be still, we are for large part of raw material still dependent on China. So as that happens, we will have to kind of be watchful of those. I think our cost of capital should remain competitive. We have to watch out of the political scenario. I mean, fortunately, today we have a very healthy competition going within the states to invite and set up the manufacturing capacity. Right now, from a policy perspective, from an environment perspective, all are fine. But I think if anything changes, let's say on that front, I think we have to sort of be careful. But frankly speaking, I don't see many risks, because I always say that this is a train which has left the station. It can slow down, but then there won't be any U-turn. So, we will see periods of slowing down, and it will happen like what precisely is happening in API industries this year, in last 7-8 months. But does that mean that the opportunity is over forever? No. But so you will see those kind of periods of pain points in every industry, not only in APIs, chemical, every industry, and we have to kind of navigate them through. But otherwise, I don't see many sort of risks to this.
Sure. On that note, thank you, gentlemen. It was an absolutely engaging, enriching conversation for me. I hope all of you liked it too.